A number of options are available on the market when it comes to mutual funds and other forms of financial products. And because there is such a wide variety of mutual funds, it is not always easy to differentiate between the various categories of funds due to the sheer number of options. Due to the fact that their names are so similar, the situation is more confusing when discussing balanced funds and balanced advantage funds. Let's take a closer look at these two different kinds of funds so that you can comprehend the distinction between them. These funds differ on myriad grounds including allocation, expense ratios, and taxation. Both are different kinds of hybrid mutual funds that allow you to invest in multiple asset classes depending on the scheme. Investing in hybrid funds allows you adequate exposure to equities, debt and other asset classes including fixed income plans. The idea behind parking money in a mix of many asset classes is to diversify the portfolio. Instead of buying stocks of varying risks and earning potential, you may invest in these funds that will help you earn while mitigating the inherent risks involved. We talk about the need to diversify our investment portfolio. But does diversification through hybrid fund investments really help? Viral Bhatt, founder, Money Mantra says, "I will definitely suggest hybrid funds for both short-term and long-term financial goals. The mix of equity and debt yields returns along with a sense of stability irrespective of market movement. If you are worried about market volatility and the recurring market downside movements, I will suggest these hybrids to protect your investments against the continued downsides." There are different types of hybrid funds, with conservative hybrid funds, aggressive hybrid funds, multi-asset funds, dynamic asset allocation funds, and more. This allows you to diversify within the hybrid category and invest without worrying about the volatility in the equity markets. Both balanced and balanced advantage funds invest in an array of equity and debt securities. However, they invest in the extent to which they invest in each of them, expense ratios, and taxation benefits. To start with, in balanced funds, you will see an almost equitable distribution to both asset classes. The minimum allocation to each asset class is 40%, which means that these funds can either invest 50-50 in both kinds of assets or 40% in one and 60% in the other. However, balanced advantage funds are bound by no such guidelines regarding asset allocation, thereby allowing the fund managers the much-needed flexibility to switch between these assets depending on the market conditions. The predefined asset allocation explains the stability of the returns in balanced funds compared to their balanced advantage counterparts in the long run. Balanced funds are treated like debt funds for taxation purposes, which means they are subject to income tax guidelines just like debt funds. On the other hand, balanced advantage funds can be taxed as both equity or debt depending on the asset allocation at the time of redemption. The expense ratios of balanced and balanced advantage funds also differ widely, which helps you realize how much the asset management companies are charging to invest in the market on your behalf. Before investing in any of these mutual funds, you must be aware of your investment objectives. Apart, be judicious about the investment frequency and tenure depending on your financial goals and risk appetite. Parking money in mutual funds helps only when you are aware of why you are investing and the estimated corpus you would like to have in the near or distant future, depending on whether you are in the game for a short term or a prolonged term extending beyond a decade or more.